You know that feeling right before a massive storm hits? That eerie silence where the wind stops, the birds go quiet, and everything just pauses? That's exactly where we are right now in the gold market. And if you don't understand what's happening in this moment of silence, you're going to be completely blindsided by what comes next. Let me show you something that should make your blood run cold. Central banks just accumulated over 1,045 tons of gold in a single year. Now you might be thinking, okay, so what? Central banks buy gold all the time. But here's what they're not telling you on CNBC. This isn't normal buying. This is panic buying disguised as policy. The National Bank of Poland led the charge with 90 tons. But it's not just Poland. It's a coordinated global movement. Central banks now account for more than 20% of total global gold demand. 20%. A decade ago, that number was around 10%. They've literally doubled their share of the market, and they're doing it quietly, methodically, like someone loading up on supplies before announcing there's a hurricane coming. Think about what that means for a second. These are the same institutions that have access to every piece of economic data before you do. They see the treasury reports. They're in the rooms where interest rate decisions are made. They know what's coming down the pipeline, and they're converting their reserves into physical gold at a pace we haven't seen in modern history. But here's where it gets really interesting. While central banks are accumulating, total gold demand hit a record 4,174 tons. That's not a typo. Nearly 5,000 tons of gold demand in a single year. And we're not talking about jewelry demand from India or China, though that's part of it. We're talking about investment demand, institutional demand, the kind of demand that moves markets and breaks supply chains. Now, let me take you back to a moment in history that rhymes with today. It's 1971. Nixon closes the gold window. The dollar is no longer backed by gold. And for a few years, nothing happens. The market is quiet. People think, okay, we've moved to a new system, everything's fine. Gold is trading around $35 an ounce. Then 1973 hits. Oil crisis. Inflation starts creeping up. By 1974, gold is at $180. By 1980, it touches $850. That's a 24% increase in less than a decade. But here's what most people miss about that period. The big move didn't happen immediately. There was a lag. A period of silence where smart money was accumulating while everyone else was distracted by the stock market, by real estate, by the illusion of stability. The people who understood what was happening in that quiet period, the ones who positioned themselves before the storm, they're the ones who preserved and multiplied their wealth. We're in that quiet period right now. And the signs are everywhere if you know where to look. Let's talk about what's actually driving this. First, there's the obvious stuff. Inflation. Everyone can see it. Your grocery bill is higher, gas costs more, but that's surface level. The real story is what's happening in the currency markets, in the bond markets, in the architecture of global finance itself. The BRICS nations are actively working to reduce their dependence on the dollar. They're not just talking about it anymore. They're doing it. Trade settlements in local currencies, gold-backed trade mechanisms, the creation of alternative payment systems that bypass SWIFT. This isn't conspiracy theory stuff. This is documented policy from major economies representing billions of people. When you have countries that control massive amounts of global GDP actively working to diminish the role of the dollar, what do you think happens to dollar-denominated assets? What happens to the purchasing power of dollars sitting in your bank account? And more importantly, what becomes the safe haven when the world's reserve currency is being systematically challenged? Gold. Physical gold, not paper gold, not gold ETFs, not gold mining stocks. Physical metal that you can hold, that has no counterparty risk, that has been money for 5,000 years. Let me tell you about something most investors don't understand. The difference between paper gold and physical gold. When you look at the COMEX, the major gold futures exchange, there's something like 100 ounces of paper gold claims for every 1 ounce of physical gold in the vaults. Think about that. It's a fractional reserve system for gold. As long as everyone doesn't ask for delivery at the same time, the system works. But what happens when confidence breaks? What happens when institutions start demanding physical delivery? We've already seen glimpses of this. There have been moments where the spread between physical gold and paper gold widened significantly. Times when you couldn't get physical metal at spot price. You had to pay premiums, and those premiums tell you everything you need to know about real supply and demand. Here's a story that illustrates this perfectly. Back in 2008, during the financial crisis, there was a moment where gold dipped below $700 an ounce on paper. But try to buy physical gold at that price. You couldn't. Dealers were sold out. Premiums were 10%, 15%, sometimes 20% over spot. The paper price said one thing. The physical market said something completely different. The people who understood that disconnect, who bought physical metal during that window, they watched gold climb to $1,900 just 3 years later. We're seeing similar dynamics develop right now. Physical demand is strong. Central banks are buying. Retail investors in Asia are buying. But the paper price is being managed, controlled, kept in a range. It's the silence before the storm. The calm before the paper market and the physical market violently reconnect. Now, let me address something important because this affects a lot of people watching this. If you're sitting on retirement accounts, IRAs, 401ks, you need to understand something critical. Those accounts are denominated in dollars. They're invested in dollar-based assets, stocks, bonds, mutual funds. And while those might do well in certain environments, they all share one fundamental risk: currency risk. What good is a 7% return if inflation is running at 8%? What good is a retirement account that's grown to $1 million if that $1 million buys what $500,000 bought a decade ago? This is the silent wealth destruction that nobody talks about. Your account balance goes up, but your purchasing power goes down. And here's where I want to mention something practical. If you have $100,000 or more in retirement accounts, there's a strategy worth understanding called a gold IRA. It's a way to get physical gold into your retirement account without triggering taxes or penalties. I put together a free guide that explains exactly how it works, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. No pressure. But if you're concerned about currency risk and you want to understand your options, it's worth a look. All right, back to what's happening in the market right now. Let's talk about supply. Because while demand is hitting records, supply is becoming a serious problem. Gold mining is not like turning on a faucet. You can't just decide to produce more gold. It takes years to bring a new mine online. Exploration, permitting, construction, development. We're talking 7 to 10 years minimum for a major project. And here's the kicker. Gold discoveries have been declining for years. The easy gold has been found. The high-grade deposits have been mined. What's left is lower-grade ore in more difficult locations. That means higher costs, longer timelines, more capital required. The mining industry is not positioned to significantly increase supply in the short to medium term. So you have demand hitting all-time highs, supply constrained, and a market structure built on leverage and paper claims. What do you think happens when that equation resolves itself? Let me give you another historical parallel. In 2011, gold hit $1,900 an ounce. Then it corrected. It spent years in a bear market, bottoming around $1,050 in 2015. A lot of people got shaken out during that period. They bought high, sold low, swore off gold forever. But what were the smart players doing during that correction? They were accumulating. They understood that the fundamental reasons to own gold hadn't changed. The debt was still growing. The currency was still being debased. The geopolitical risks were still present. And what happened? Gold bottomed in 2015 and has been in a bull market ever since. It broke through the old high of $1,900. It hit $2,000, then $2,100, then $2,400. And this happened while interest rates were rising, which is supposed to be bad for gold. It happened while the stock market was making new highs, which is supposed to reduce safe haven demand. Gold went up anyway because the underlying fundamentals were so strong. Now here's what's different about this cycle. In previous gold bull markets, it was mostly retail investors and some hedge funds driving the price. Central banks were actually net sellers for a long time, but now central banks have flipped. They're buyers, massive buyers, and they're not trading. They're accumulating for the long term. That's a completely different dynamic. When central banks buy gold, they're not looking at quarterly returns. They're not worried about short-term volatility. They're making strategic decisions about the composition of their reserves for decades to come. And the fact that they're doing this now, in size, tells you everything you need to know about where they think the global monetary system is headed. Let's talk about what this means for price, because ultimately, that's what people want to know. Where is gold going? Here's how I think about it. Gold is currently trading in a range. It's been consolidating, building a base. And while it's doing that, the fundamentals keep getting stronger. Demand keeps increasing. Supply stays constrained. The debt keeps growing. The geopolitical situation keeps deteriorating. Every day that gold stays in this range, the pressure builds. Think of it like a spring being compressed. The more you compress it, the more energy you store. And when it releases violently. That's what's being set up right now in the gold market. A massive release of pent-up energy. Now, I'm not going to give you a specific price target because anyone who tells you gold is going to exactly $3,000 or $5,000 or $10,000 by a specific date is guessing. But I can tell you this, when gold breaks out of this consolidation, when the paper market loses control, when physical demand overwhelms available supply, the move is going to be fast and it's going to be large. We've seen this movie before. In 1979, gold went from $200 to $850 in about 18 months. That's more than a 4x move in a year and a half. In 2009 to 2011, gold went from $800 to $1,900, more than a double in 2 years. These moves happen fast once they start. And by the time the mainstream media is talking about it, by the time your neighbor is asking you about gold, you're already late. The time to position yourself is now, in the silence, before the storm. Let me tell you about something that keeps me up at night. It's the derivative exposure in the banking system. We're talking about hundreds of trillions of dollars in notional value of derivatives. Interest rate swaps, currency swaps, credit default swaps. These are essentially bets on top of bets on top of bets. And they all assume that the underlying system remains stable. But what happens when that assumption breaks? What happens when counterparties start to fail? What happens when the web of interconnected obligations starts to unravel? We got a taste of this in 2008. Lehman Brothers failed, and suddenly nobody knew who was solvent and who wasn't. The entire system froze, and it took trillions of dollars in central bank intervention to unfreeze it. The problem is, the system is even more leveraged now than it was then. The derivative exposure is larger. The debt levels are higher. The central banks have less ammunition because interest rates are already low and balance sheets are already bloated. So when the next crisis hits, and it will hit, what tools do they have left? More money printing, more quantitative easing, more currency debasement. And what does well in that environment? Hard assets, real things, gold. Here's another angle most people miss. The industrial demand for gold is growing. It's not just jewelry and investment anymore. Gold is used in electronics, in medical devices, in aerospace applications. As technology advances, as we build more sophisticated electronics, the industrial demand for gold increases. This puts a floor under the price. Even if investment demand were to decline, which it's not, you'd still have industrial demand supporting the market. But investment demand isn't declining. It's accelerating. And it's not just retail investors. It's institutions, family offices, pension funds, sovereign wealth funds. The smart money is moving into gold, not as a trade, as a strategic allocation, as insurance against systemic risk. Let me paint you a picture of what I think is coming. We're going to see a period where gold starts to move higher. Slowly at first. Maybe it breaks through the recent highs. Maybe it hits a new record. The financial media will talk about it for a day or two, then move on to something else. But behind the scenes, the accumulation will continue. Central banks will keep buying. Institutions will keep allocating. Physical demand will keep growing. Then something will happen. Maybe it's a geopolitical event. Maybe it's a currency crisis in an emerging market. Maybe it's a major bank failure. Maybe it's just the realization that the debt can never be repaid and the only way out is inflation. Whatever the trigger is, gold will start to move. And this time, it won't be a slow grind higher. It'll be a surge. You'll see premiums on physical metal explode. You'll see delivery delays. You'll see the spread between paper and physical widen to levels that make 2008 look tame. And you'll see a rush into gold that makes the late 1970s look like a minor blip. The people who positioned themselves during the silence, who understood what was building, they'll be fine. They'll have their metal. They'll have their protection. But the people who waited, who thought they had time, who believed the mainstream narrative that everything is fine, they're going to be scrambling. And they're going to be paying much higher prices for much less metal. Here's what I want you to understand. This isn't about getting rich quick. This isn't about speculation. This is about preservation. It's about making sure that the wealth you've built, the retirement you've planned for, the security you've worked your whole life to achieve, doesn't evaporate in a currency crisis or a financial system meltdown. Gold has been money for 5,000 years. It's survived the fall of empires. It's survived wars, depressions, hyperinflations. It's the one asset that has maintained its purchasing power across centuries. An ounce of gold could buy a fine suit in Roman times. It can buy a fine suit today. That's what real money does. It preserves value across time. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. The British pound has lost even more. Every fiat currency in history has eventually gone to zero. Not some of them. All of them. The only question is timing. And the signs we're seeing now, the central bank buying, the record demand, the supply constraints, the geopolitical shifts, they all point to the same conclusion. We're closer to the end of this currency cycle than the beginning. Now, I'm not saying the dollar is going to zero tomorrow. I'm not saying you should panic. But I am saying you should prepare. You should have a portion of your wealth in assets that aren't dependent on the solvency of governments or the stability of the banking system. And for most people, that means gold. Let me address a common objection. People say, gold doesn't pay interest. It doesn't pay dividends. It just sits there. And that's true. Gold doesn't generate cash flow. But that's not its purpose. Gold is insurance. You don't buy fire insurance on your house expecting it to pay you dividends. You buy it hoping you never need it, but knowing that if disaster strikes, you're protected. Gold is financial insurance. It's protection against currency debasement, against systemic risk, against the kind of events that destroy paper wealth. And right now, given everything we've discussed, given the record central bank buying, given the supply constraints, given the geopolitical situation, the cost of that insurance is remarkably cheap. Think about it this way. If you knew with certainty that a major financial crisis was coming in the next 5 years, how much of your wealth would you put into gold? Probably a significant amount, right? Well, you don't know with certainty. Nobody does. But you can look at the probabilities. You can look at the debt levels, the derivative exposure, the currency wars, the central bank policies. And you can make an informed decision about how much insurance makes sense. For most people, that's somewhere between 5% and 20% of their investable assets, enough to provide meaningful protection if things go wrong, but not so much that you're betting everything on one outcome. It's about balance. It's about prudent risk management. Here's another thing to consider. The opportunity cost of being wrong. If you buy gold and nothing bad happens, what have you lost? Maybe some potential gains in other assets. But you still have your gold. You can sell it. You haven't lost your principal. But if you don't buy gold and a crisis does happen, what have you lost? Potentially everything. Your purchasing power, your retirement security, your financial stability. The asymmetry of that risk-reward is heavily skewed toward owning gold. The downside of being wrong is minimal. The downside of not owning it and being wrong is catastrophic. Let me tell you one more story. I know someone who lived through the hyperinflation in Zimbabwe. He told me about watching his life savings become worthless in a matter of months. He had money in the bank. He had a good job. He thought he was secure. Then the currency collapsed. Suddenly, his bank account couldn't buy a loaf of bread. His salary was worthless by the time he got paid. Everything he'd worked for, gone. But he had one thing that saved him. His grandfather had given him a few gold coins years earlier. He'd kept them, not really thinking much about them. When the currency collapsed, those coins became his lifeline. He could trade them for food, for supplies, for the things his family needed to survive. While his neighbors were starving, while people were rioting in the streets, he had a way to preserve his wealth and take care of his family. That's an extreme example. And I'm not saying we're headed for Zimbabwe-style hyperinflation, but the principle is the same. When the system breaks, when paper wealth evaporates, physical gold retains its value. It's the ultimate form of financial security. Now, we're in the silence, the calm before the storm. The market is consolidating. The mainstream is distracted, but the smart money is moving. Central banks are accumulating. Institutions are allocating. The fundamentals are building pressure like a coiled spring. And when that spring releases, when the storm hits, it's going to be too late to prepare. The premiums will be too high. The availability will be too limited. The prices will be too far gone. The time to act is now, in the silence, before everyone else figures it out. You have a choice to make. You can ignore the warning signs. You can trust that the system will hold together, that the debt doesn't matter, that the central banks have everything under control. Or you can look at the evidence. You can see what the central banks themselves are doing. You can understand the historical parallels. And you can take action to protect yourself and your family. The silence before the storm is a gift. It's an opportunity. It's a chance to position yourself before the chaos begins. But it won't last forever. Storms don't announce themselves with a press release. They just hit. And when this one hits, when the gold market breaks out, when the paper system loses control, when the rush for physical metal begins, you'll either be prepared or you won't. The question is, which side of that divide do you want to be on? Because the storm is coming, the silence is ending, and what you do right now, in this moment, will determine whether you weather what's ahead or get swept away by it.